In 2026, there will be three main factors that will drive an increase in M&A activity. Firstly, an interest in strong deposit books. By and large, survey respondents indicated that a strong deposit base was one of the most motivating factors to execute a transaction, and that won't change in 2026. However, what will be different is an increase in the focus on ancillary revenue streams which could be attached to those deposit bases, as we've seen an increase in interest in wealth management, trust, and insurance type divisions for an acquisition target. The second factor is potential changes in the regulatory environment and an increase in the thresholds for compliance with certain internal control standards for banks. If this changes, it will allow an increase in the asset size that is needed to require an increase in internal control compliance. And as we all know, you can't talk about bank M&A without also talking about compliance costs and scale and profitability. And so changes in those thresholds will allow for larger transactions to take place and introduce potential players who wouldn't have considered M&A because they didn't want to trip that threshold. And the third factor is the relative stability and profitability in the industry. Over the trailing quarters of 2025, we saw more banks announcing record profits. And with increased profits come increased capital and the greater ability to execute an M&A transaction. The increase in potential bank buyers who are saying that there is a lack of suitable targets is always going to come down to a numbers game at its onset, where what's typically perceived as the sweet spot for acquisitions in that $1 to $5 to maybe $7 billion range, the number of banks are decreasing as the industry continues to consolidate. However, when we think about what's different this year from other years, it's important to focus on what's actually motivating a buyer to think that a target is suitable. We look at things like the target being in a growing geography that is strong and suitable to align with the buyer's portfolio. We look at credit quality, specifically looking at the increase in originations in growing industries and industries that have the potential to continue growing in the future. And lastly, we have to consider the continual disconnect in pricing between buyers and sellers. Suitability is always going to come down to price, and the buyers need to believe that they can acquire a target that fits into their risk tolerance and their strategy for a transaction. When looking at the results of the 2026 Bank Director M&A survey, we did see a disconnect between the number of sellers who thought there was a suitable buyer out there and the number of buyers who thought there were suitable targets they could find. And this was largely driven by sellers overestimating what buyers thought was attractive in looking at a target. A lot of times the sellers are looking and focusing on net income, right? What's their profitability look like? What's their non-interest income stream look like over a period? But a buyer may not be focused on that as their primary motivation. Buyers are looking for strong deposit bases. They're looking for opportunistic and synergistic value, and they're looking for a target that meets their M&A strategy and furthers their goals. And the sellers may not be focusing on that. Another factor does come down to numbers and timing. Just because you're willing to sell and there is a buyer out there who's willing to buy doesn't mean the timing's right. And if certain things internally aren't lining up with that buyer's timeline, it may create a situation where there just aren't as many buyers as you think there may be in the industry. As a seller looking to maximize your potential sales price, there are two main things that you can focus on from the perspective of a buyer that could help you yield a higher value. The first is looking for any skeletons in your closet and truly understanding your organization and what a potential buyer may see as a risk. The second thing is really understanding what makes your organization special and why would a potential buyer want to acquire you over a similar target. These could be things like your loan portfolio and where you're lending or the certain industries you're in that you're projecting to grow. It could be things like how you've been optimizing technology, perhaps integrating certain AI solutions to improve efficiencies in your organization. Being able to understand those avenues that make you unique allows you to tell a better story to a potential buyer and yield a better price. Survey respondents, by and large, said that they believe organic growth in 2026 will be fueled by increases in lending in both C&I and CRE loans. And this, by and large, will likely be the case. However, what will distinguish a successful bank from a non-successful bank in obtaining that organic growth is how you focus your strategy on obtaining those loans. A lot of times in the industry, when we're looking at the potential trajectory of the economy, we look at national indicators like GDP. Sometimes we'll dig into local indicators like what's my local unemployment rate. But it's important to know that not all industries are going to grow the same. And again, what will distinguish a successful bank from one that's not as successful is how you strategize and focus on those industries. Is your lending team getting together and looking at those specific forecasts to understand that maybe my historical portfolio in hotels isn't going to be successful in the future? Or is there a new opportunity that I have to jump into a line of lending that will be growing based on those projections in the coming years? Focusing your team on those industries that will see growth broadly versus just broadly focusing on C&I or CRE lending is how you'll differentiate your organization's profitability.